Hey guys, appreciate you joining. We're going to give it a couple seconds so people can get in here. Okay, that was a couple seconds. So today, if you follow me at all, I talk about a lot about cash value life insurance and kind of the misconstruation of cash value life insurance and just term insurance, all insurances in general. So today, this webinar is going to be breaking financial myths and unlocking wealth with strategies like life insurance. So today on this webinar, we'll talk about term insurance, pros and cons, whole life, index universal life, infinite banking, all the buzz phrases you've been seeing on social media. Just so you know, my name is Dustin Wiley, owner and operator of Viking Financial Group. About 4 or 5 years ago, I got started in the industry just because there was a guy at the gym. He had a nice little SUV, a Mercedes G-Wagon, and he had a big watch at the gym. And I was like, this guy makes a lot of money. Good for him. He was on a phone call. He was talking about, the market's down. The best we can do for you is a 1% CD. I was like, I don't know much about finances, but that doesn't seem right. I did a quick Google search and saw CDs for 4%. And I was like, this guy is a scam artist. He has all that money because he's screwing people. And I knew the guy he was on the phone with, and he was a hardworking blue collar guy like myself. And I thought, man, I'm in the wrong industry, not because I want all that money, but like I could save those people and I could make money and I could get out of the sun. I want to do that. So I basically just drowned myself in information, read books, did the webinars, bought training courses, drowned myself like an ostrich sticking your head in the ground for about a year or two straight. Social media marketing kind of took off. People liked what I had to say, talking about, hey, this is what an IUL actually is, and this is what your financial advisor says. This is what Dave Ramsey says. I believe in half of what he talks about, and here's, the reason why he does the rest of it. So, with that being said, that's my story. I'll let David kind of go over how he got into the industry.
Hey guys, for those of you who don't know me, my name's David. If you ever hear Dustin call me Fish, it's because my last name's Fisher. That's just what I've gone by my whole life. But similar story as Dustin, meaning that I initially became a client in this industry first because I needed some help with retirement planning. And I started seeing a huge lack of knowledge when it came to the people prescribing these plans and not really doing a professional approach. It just seemed like a very one size fits all scenario, and I was kind of shocked by that. So the big thing that I love is I love math and science, and I was always a huge nerd. I wanted to do in college the farthest thing from English possible because I just hated speaking and writing, and funny enough, that's what I ended up doing for a living. But the reason I say that is because I love math and data, and I was shocked that the whole financial industry at large just ignored a lot of the data on how to utilize these plans effectively in people's retirements. And one of my first clients when I came into the industry was my dad, who was literally a rocket scientist. And I always tell people that if he was a rocket scientist, one of the smartest people I know, and he didn't know about these tools, who else doesn't know about these and who else is going to be confused when it comes to these products? And that's why we're doing this seminar, is to simplify this stuff and just to tell you that you're not alone if you feel confused and you see a lot of marketing on these topics. That's what we're going to hopefully go through today with you.
Yep. I'm going to move us around a little bit just because all these slides are all over the place. So a little bit of introduction. Have you ever felt like the financial industry is just designed to keep you confused rather than informed? Most of the reason why you're probably here is because you have a lot of information online that you're like, I'm overloaded. There's so much going on. I don't know who to believe. I like Dave Ramsey because he's a Christian, but it doesn't seem like he's giving me the right information. I like Ramit Sethi, or however you say his name, because his book is really informational, but he doesn't talk about tax planning. All these different people have different ways of pitching you on their idea, and you're just like, you're totally confused. And trust me, it's done on purpose. Today, we're going to overview, myths on term, whole life, IUL, infinite banking. It's just different types of life insurance, how you can use it for life insurance, how you can use it for removing all the stress off of your retirement portfolio, or just, infinite banking. How can I make money off of my savings versus it sitting in an interest-bearing account, earning 0.1 or 0.01%. And it's very important to understand these financial tools, that they are not a one size fits all. So if anybody approaches you and says, yes, this is the one thing that you need, this is how you need it, run. They're trying to sell you something, whether it's a product, whether it's a mutual fund, whether it's an assets under management, whether it's something they do and it's all they do and it's all they push, they are trying to sell you something. So the reason why we say it's important to understand these financial tools, they're not Swiss Army knives. Are they good for the greater population? Sure. That's why you're here. That's why we're going to talk about it today. And the last thing, clashing information online. If you follow me at all, if you don't, that's fine. You know that that's all I talk about. is gurus, online social media, uh, influencers that'll tell you, hey, avoid this, do this, avoid this, do this. What I normally say, and I guess I'd be considered a guru, is hey, here's the information. Here's what a Roth IRA is. Here's what a mutual fund is. Here's what this is. Here's what that is. What do you think? Because you know you better than I do. We could sit for 2, 3, 5, 6 hours and I could get to know you, but we all know that there's a portion of us that no one knows. People don't know me fully. My wife doesn't know me fully. So if I give you the information, you're going to know, like, hey, I know where I'm headed. I know what I want. This fits my bill, and that's kind of how I pitch myself. So, David, do you have anything on that clashing information?
Yeah, this is a favorite topic of mine just because, like Dustin said, if you follow him, you're probably on some type of social media like most of the world. As you've probably seen, there's people who say that you should put all your money into life insurance and nothing else. And then there's the other side of the spectrum, which is, the Ken Fishers, Dave Ramsey's, that you should have really no money in permanent life insurance at all. You should put all of your money in the market. As you know, when it comes to absolutes, usually the truth is somewhere in the middle, or the extremes is somewhere in the middle. What I would generally recommend when it comes to people trying to figure out what's real, what's not real, when it comes to all these different topics, is the truth is almost always somewhere in the middle of those extremes. And that's where you really have to stress the importance of working with a professional who can figure out what specifically that's going to look like for you based on where you're at, your goals, your needs, and your retirement income and things like that. So that's just all I would say there is if you feel like there's differing information all over, it's simply because you have people on both those extremes who are very loud and the people in the middle who are professional planners, they're generally not as loud. And that's where we can help you figure out how the stuff could benefit you or even if it would be a benefit.
Yep. And then one last thing I just thought of, we said clashing information online. It's also clashing information in your life. If you have a coworker and they make the same amount of money as you, they drive the same type of vehicle as you, have the same size house as you, and they're trying to tell you how to save and how to invest and what life insurance, you should get, they're on the same boat as you. They have the same knowledge base as you. They're just very opinionated. So don't always listen to your broke uncle. Don't always listen to your boss. You need a very wide plethora of information, kind of niche down, like you said, for your specific situation. I'm going to shrink us this time. Okay. Actually, I'm going to put us on the bottom left. So common financial myths: buy term and invest the difference is always the best strategy. So there are a couple captive carriers out there. Captive just means you are captive by them. They hold you captive. They are the captain now. You can only sell what they tell you to sell. You can only have the products that they say you can use. And with buy term and invest the difference, BTID, that was kind of coined by Primerica. Primerica is an echo chamber. All they do is they sit around and talk about buy term, invest the difference that you were going to put in permanent insurance. So that's one thing that a lot of people just don't explain. What does it mean by buy term and invest the difference? It means if permanent insurance was going to cost you $500 a month, buy term at $50 a month, put the other $450 into the market. So that's what buy term and invest the difference means. That is again a always or never situation, and you want to avoid that. Whole life, another myth: whole life insurance is a bad investment. Whole life, meaning permanent insurance, IUL, VUL, whole life, UL. There's a lot of different types of permanent insurances. They're not an investment. Technically, the definition of an investment: put money in, it can grow, it can lose, all in between. Within life insurance, you have guarantees, you have fixed returns, you have floors and caps, you have all these different guardrails like bumpers up when you're bowling to keep you from losing value. So it's technically not an investment. The third myth is IUL is just another scam. I would say that VUL is a scam, and the reason why a lot of people, financial advisors, think that IUL is a scam is because back in the early 2000s, 2010s, VUL, variable universal life, has no guardrails. It's very expensive. You can lose it all, you can gain it all. It was sold like hotcakes. Everybody and their dog that was licensed to sell it sold it. And most of those policies went under because the structuring was horrific. Not only was the tax code not really great at the time, beneficial for those policies, but the advisors, either they did know how to structure them, but they didn't do it because they wanted that fat commission, or they didn't know and they were just selling something they didn't know. So they're seeing a repeat. It's like IULs, these MLM, IMO, these life insurance only companies are just pitching, just like Fisher said a minute ago. IUL is the only way. Stop your 401k with a match, put everything into this. It's so much better. That's the reason why most people think IUL is another scam because it's just mirroring what actually was a scam. But if you really know the basics and the ins and outs of an IUL, you realize that as long as it's set up correctly, it is a humming machine and it will take off so much stress from your portfolio. The last part, banks and wealthy people don't use life insurance. It's kind of funny because most financial advisors say that the opposite. Only banks and wealth people use like cash value life insurance. The reason why is wealthy people can afford these type of policies. You know, if you're not putting in $100,000 per year, you shouldn't have an IUL whole life. So it's kind of funny that this is one of the myths. And saying that banks don't use life insurance, here in a second, David's going to show you. Banks own a significant portion of all cash value life insurance. It gives them just a safe rate of return. You know, if one of their higher up CEOs, COOs die, they have a lot of life insurance on them, they can replenish their bank. Lots of different reasons how you can use it or ways you can use it, but that's the myths and kind of talk about the realities because David's a little more well spoken. I'm going to hand it over to him.
With the realities of a lot of these things is there's a sliver of truth in the myths, but we have to make sure we're looking at it appropriately. So with term, again, there's nothing wrong with term. I don't want people to think that term is good or bad. It's again just a financial tool. But here's the thing, it is temporary coverage. And if you're a 30-year-old and you have that term last till 60, you have that term and you pay in all that money during those years and then it expires. And now what happens? Most of the time, what we see is people still want coverage at that point because they haven't built up enough assets to where they thought they'd be self-insured by now. And now they try to get a policy at 60 and they either can't because they're not healthy enough or they're so unhealthy that it's extremely expensive and they can't even afford it. So that's the bummer with temporary coverage is it will lapse at one point, and as a pure cost, you don't get any rate of return or investment back from that. When it comes to whole life, same thing. Whole life is a very misunderstood tool. When people talk about it as an investment, it is 100% not an investment. All whole life is supposed to be is it's a foundational financial tool that gives you really good liquidity if we structure it properly. It gives you great guarantees where if someone doesn't want to have excess money sitting in the bank, that they just have parked there for unknown reasons. They don't know where to put it because they want it liquid. You could earn a better rate of return in a whole life. It's not going to be huge, but you could earn 3.5%, 4%, almost basically guaranteed, and have it fully liquid instead of having it in the bank doing, 0.5%. So that's where we would see whole life be used in someone's portfolio. IUL, same thing. Whenever someone uses the word scam or any extreme language, usually what we find is that they have some type of agenda of, hey, this is a scam, do this instead, which is exactly what you see. People say IUL is a scam, put your money in the market. But the reality of what IUL helps with is it's just meant to be a bucket of safe growing money where you can have tax-free growth. And that money is fully liquid to you to be able to not give up the opportunity cost to do other investments along the way during retirement. So that's where IUL fits in. Same thing when it comes to banks and wealthy people. They have billions of dollars in banks and cash value life insurance simply because of the safety and liquidity. The reason they have so much of the money there is it's classified as a tier one asset. All that means is that if there's a run on the banks have to have a bunch of money ready to be able to withdraw. Let's be real, we're very close to having these types of things happen now compared to years and years and years ago with where we're at economically. So that's where banks go to put safe money where they want to have earning rates of return, but they don't want to give up liquidity is different types of life insurance. That's exactly what they use it for.
Yep. And if you look at this um, picture real quick, it's quick math is $70 billion. This is 3 years old, but the top five banks has $70 billion in life insurance assets. That's not death benefit, that's life insurance assets. That's how much cash they have in their accounts. I'll put us over this nice little family silhouette. So term life insurance, we talked about it before. It is not a scam. It is also not for everyone, but it is for most people because it is a cheap death benefit option. Who's it for? Young families. Let's talk about a young family. Say in this picture, we have three kids, husband and a wife. Husband makes all the money, wife stays at home. If that husband makes $100,000 a year and through work he has a $100,000 policy, guess what? When he dies, the wife gets to be single for 1 year. And that's if she wants to be. She might want to go back and save some of that money. So you got to think like, if I only have my work term, In 6 months, my wife will be remarried. Versus if you get a 30-year term that replaces 30 years of your income, that's $3 million. Now you can rest assured that if she wants to stay single, if she really loved you, she's going to not be in someone else's bed for the next 30 years. And I know that's kind of an awful joke, but another thing is for business owners, if you have a lot of debt, if you handle a lot of cash, if there's, a point where you're like, man, if I pass away, this company is going under. Term insurance is huge. If you got 20 years left in your working years, get a 20-year policy. If you have 10 years that you're really building this business up, and then the next 10 years you're going to be on the downhill of like, hey, I'm going to slowly sell the business off to one of my employees. You can do what's called laddering insurance. It's critical period. So you can have a 20-year term of $1 million, and you can have a 10-year term of $1 million. So now you have $2 million of coverage for 10 years. And then when you don't need as much coverage, you have $1 million afterwards. So that can also lower costs. And we can talk about key persons real quick. Let's say you have 10 employees, and if one of those employees quit or died, you would just be up that creek without a paddle. So you can have a key persons policy, say for, once again, 10 years of wages. They make $100,000, have $1 million policy on them for 10 years. If they pass away, you have enough money to go hire someone, train them, or just take someone in the company, train them up to be the replacement for that person. So a lot of people don't think about key persons insurance enough. If it's just you and your partner, you want to have it on your partner as like a buy sell agreement. Let's just say that you have a wife and your partner has a husband, and you pass away. Well, now your wife can't run that business because she doesn't know it, or their husband doesn't know your business, but your partner's with them. So why not have a policy, a buy sell agreement for, let's just say $1 million again, where if you pass away, you can pay off that spouse to just go away, let me have the business and run it. And now you're not having to be in a partnership with your partner's spouse. The benefits, of course, I mean, it's pretty common sense from what we just said. You get a lot of coverage for little cost. It can protect your income and debt. Again, if you have income and you want to get 30 years, your annual income to make sure that that's taken care of, it can do that. If you have a lot of debt, say you have, a business and 90%, you only have, 10% liquidity in all of your assets, you have 90% debt, you want to cover all that. If you pass away, your family's not having to take it over. And you also want to look at convertible term. A lot of people never heard of convertible term. Let's say you get a 30-year policy and in 5 years you come down with cancer. You're no longer insurable. In your mind, you're like, if I live another 25 years, my policy's over with and it's going to be a miserable existence. But if I live 26 years, now my family gets nothing. So if you get a convertible policy, the day you find out you're sick, you can now convert up to that full death benefit to permanent. So I have $1 million of coverage. 5 years in, I convert it to whole life. Now, your premium may have been $150 a month. Now it's going to be like $700 a month because you're buying something that's permanent that will never lapse as long as you pay the premium, but you're getting the guaranteed insurability. If you get sick, if something happens where you cannot get life insurance anymore, you are guaranteed insurable. And you probably know someone that they came down with some illness, they got in a car wreck, something happened, they got a felony, and all of a sudden now they can't get coverage. This will deter that. One little quick side note, 1% of term policies pay out. And I don't want that to scare you away. The reason why 1% pays out is 99% of the time, you either outlive it, so you get a 10-year policy, and you live longer than 10 years. So it lapsed. It covered you in the phase that you wanted to be covered in, so it was fine. The other is, hey, I lost my job, bills are getting tough. I'm going to cut that one expense that I don't need, the term insurance. You cut it. So now 99% of policies don't pay out. And you'll be really surprised of that 1% that does pay out, a significant portion of that actually goes into a state fund because agents don't tell spouses where the policy is, which company it's with, who to call, how to actually get that death benefit. So there is billions of dollars of death benefit just floating out there that no one knows how to get a hold of. No one knows who the beneficiary is. So again, it's very important to pick the right advisor or agent. And if you see this little number list in the middle, this is actually an illustration for a $1 million term policy for 30 years for a 30-year-old. So if you look right above that arrow, the last 1652, that is the annual cost at age 60. It's about, $140 a month. So that term insurance was really cheap for 30 years. But on the 31st year, you still have insurability. You can still keep that policy, but it literally 10x in cost. You went from $1,600 a year to almost $16,000 a year. So Primerica, I'll just use them, they tout the term 80. So if you're 30 years old, you get a 30-year term and they call it a term 80. They're like, hey, you're insurable until you're 80. Cool. Well, guess what? When you turn 60, 10x is your new cost. And guess what? 30 years down the road, when you find that out because no one told you that this is a graded policy after the age of 60, meaning the cost goes up, you're going to wish that you went back in time and got the permanent policy. So if you do the quick math, it costs $50,000 over 30 years, and it costs about 300 grand over the next 10 years. Ridiculous. If you add all that together, it's like 350 grand. If you were to put that 350 grand over 40 years into a cash value policy, it could be worth like $800,000. And your death benefit could be $1 million. Your $1 million in your term policy, it's not liquid, can't access it, it's just death benefit. But in that cash value policy, you have $800,000 of cash at 60 or 70 years old that you can use, that you can deploy, that you can pay off debts. So, not saying that term is bad, but it's just like there are two different paths that you can take, and it's really, really important to get with someone who can go over your whole financial picture and see exactly what you need and not what you think you want. Because we talked about on another webinar, you may think you know what you want, you may think you have the right questions to ask, but after talking to somebody who knows what they're talking about, you actually might have questions that blew your mind that you didn't even know that you had. So again, term is not a scam. You have anything else on that? I know I just rambled.
No, I think that was perfect. The only thing that I'll chime in a tiny bit more on is when it comes to term, life insurance is one of those things where I've rarely found people who are 60 or even 70 years old that don't want insurance anymore. So what happens is exactly like Dustin's saying is you might have a 30-year policy that's super cheap. You're getting to the renewal and you're starting to examine other coverages. And I just had a client last week that we were chatting with, and it was $900 a month for them for like another 5 years of coverage for 300,000. It was insane. So we did the math and we're like, why don't we just put this amount instead of putting it into term, put it into a permanent policy with a little bit less coverage? It's going to build some cash for you. It's going to supplement retirement. Yeah, the death benefit will be lower, but you'll actually get some equity out of it. Because the big thing with term is it's like renting a house. You have no equity. It's just a pure cost. And owning is like having permanent coverage where you get equity and you get all these benefits from it down the line, but it does take longer to build up.
I think you wanted to talk a little bit on health too. The reason why term policies are so cheap is if you're healthy, but if you're healthy,
Mm,
you outlive the policy, right?
yeah, that's one thing. I don't know if you guys have followed Gary Brecka ever. He's kind of this health guru. Again, word guru always makes me laugh, but what he did is he did a lot of research on the underwriting processes of insurance companies. And basically, what they can do is they can predict within about, I think it was 2 months of when you're going to pass away based on all the data that they have, because that's how they do the underwriting is they say, this person's not insurable. They're too likely to pass away during this period of coverage. We're not going to insure you. So the reason I say that is because if they won't insure you, it's because you're too likely to have the benefit pay out. And that's not how term works. They don't want it to pay out. It's literally meant to not pay out. So if you do get covered, that means if you're pretty healthy, guess what? You're most likely going to outlive that coverage. You might just want to look into some permanent coverage or at least get a convertible one, like Dustin said, so that in the next couple of years, when your income goes up, you could convert to something and have it permanently instead of just wasting that premium.
And it may sound like I'm bashing term here at the end, and I'm not. Imagine you were a plumbing service and 99 out of 100 calls, you could just get your payment and not unclog the toilet. But on the one toilet at the very end, you have to unclog it. That's 99% of the time you don't have to do your job, which is term insurance. Only 1% of the time do they have to actually deliver. So again, not trying to bash it, but that's just something to keep in mind if you're looking at your entire plan just versus, hey, I need life insurance. And Fisher, I know you are the whole life guru right now. Guru,
Oh
good
gosh.
word. I'll let you handle this one.
Again, whole life, it's not good or bad. It's just another tool. That's what we really want to emphasize with all of these. And you have to know how to use it, who it's for, and what the benefits are. So with whole life, it is a type of permanent cash value life insurance. That just means that there's death benefit. that's permanent and a cash value that goes along with it that grows based on different methods. So quickly, who is whole life for? It's really going to be for people who are, I would say, having too much money in the bank sitting there that they don't know what to do with it. They want liquidity. They want a better rate of return than the bank, but they don't want to give up access to their capital. The other side of the spectrum is people who are wealthier, who have money for permanent coverage that they just want to have a death benefit paid to their estate and have wealth transfer. Those are usually the two extremes. It's either I want really high liquidity, really quick access to my money, or the other side of it, I want as much coverage as possible permanently to give to my heirs and death benefit. That's the two spectrums. With benefits, how the whole life basically grows is it grows with a guaranteed interest rate, which is called a non-forfeiture rate. All that means is net of the fees, it's usually going to get you about like 3%, somewhere around that. It's a little bit different with every company, but that's usually on average what it is. They will give you the guaranteed rate plus a dividend, which most companies will say that, hey, it's paid out. You know, we're a 200-year-old company. We've paid out our dividend every year for the last 200 years. But what they don't tell you, which is kind of misleading, is they don't tell you how much the dividends have changed. So dividends are directly tied to the profit of the company, and the profit of the company is directly tied to interest rates and Fed rates and, you know, overall profitability of the company as a whole. So what happens is, just to kind of give you some history, interest rates were very high in the 1980s. I think we all know this. If you guys bought a mortgage back then, it was what, like 17%, something like that. Dividends and whole lives back then were very similar. They were 17, 18%. Would you like to guess what dividends are now? 4 to 5%, something like that. So they fluctuate all the time. But here's the thing, the dividend is not guaranteed because they can change the dividend payment, but most of these companies have paid it, but they do have the ability to manipulate it. So that's the one thing I want to make sure people understand is if you're looking at any whole life illustration and it shows, hey, this is what it's going to look like 30 years from now, we really don't have any idea because interest rates are going to change. A lot of different things. The policy might change, costs might change. Marketing a whole life as a guaranteed product is very hard for me because people don't understand the different levers that can be pulled. So going to the right-hand side, when it comes to whole life, typically people use it for a guarantee because they want a conservative rate of return and they're very pessimistic about the market. I've rarely met people that are that pessimistic that they would prefer a 4% rate over something that could gain a little bit more, but some people are like that. So it does have more guarantees than some other types of life insurance out there. When it comes to the cost of insurance, whole life is again meant to be a very guaranteed sound product. It's not meant to be doing crazy rates of return. It's not meant to be like a sports car. It's not meant to go fast and earn you tons of interest. The whole life cost of insurance is built majority to the beginning of the policy. So what I mean by this is if you ever look at a whole life illustration, you'll see that you don't really gain any money until about 15 years into the contract. The reason is because the whole life cost of insurance is prepaid in the beginning, very similar to a mortgage. In a mortgage, what do you pay the most of in the beginning? Do you pay interest or do you pay principal? In a mortgage, you pay mostly interest for the first 5, 10, 15 years. 15 years is usually when it breaks even and you're paying about half and half. That's almost identical to whole life because you're paying so much fees in the beginning that the break even point isn't even for 15 years in the policy typically. All that means is, let's just say you were funding a policy pretty heavily. You were putting in $10,000 for 15 years. At the 15-year mark, you would have put in 150,000. At that point, 15 years, you would have that same amount in cash value, which means your break-even point, you took 15 years to be profitable on the money that you put in, which is a very slow wealth building tool, which is why we usually don't recommend it for retirement planning because it just doesn't keep up with inflation and what we need it to do in terms of safe and productive rates of return. So that's about the cost of insurance. With the amortized fees, again, all that means is all the fees, or majority of the fees, are front loaded in the beginning, and it's very hard to get the cash value to catch up above that. That's why the policy grows so slow over time. It's just because it's meant to be very conservative. Think of a mortgage. You know exactly what you're going to pay for the next 30 years. It's never going to change. A whole life is very identical to that. The one, again, thing to summarize, where this can be valuable for people is if they want very, very high liquidity and want to pull money in and out for different strategies that we'll go over later. You can take money out of a whole life 30 days after putting it in if you do it the right way. Other side is death benefit. And like we said, if you're a type of person that doesn't want to have your money in the bank where they control it and you're having some control and leverage over it, then a whole life might be a good situation for you for better guarantees and liquidity.
If you didn't watch the Financial Literacy 101 webinar, you might want to go find that. We talk about the amortization fees just so you understand that. Let's say your mortgage is $1,000 a month. At the very beginning, about $990 goes towards the costs, the fees, to go to the banks, to go to whoever holds your mortgage, to pay them first. So you're paying down your mortgage by $10 the first month. It's like, here's your costs. $990 goes towards cost at the beginning, and in a 30-year, at the very end, 990 will go towards your principal, 10% go to the cost. So just know up front, you're paying for mostly fees. And again, that's why I said it takes about 15 years to break even. Another thing, because I never know who's going to jump on these, talk about estate taxes really quick. Right now, the exemption's about, we'll call it $28 million. So your first $28 million is tax free whenever you pass away and it goes to your heirs. If you're worth, let's say, $28 million and you're like, hey, I'm good if I pass away, and you have a $10 million life insurance policy, that is added to your estate. So now your estate is worth $38 million. Although whole life insurance is tax free, if your estate is above that exemption, now you have to pay 40% tax on anything above that. So your $10 million policy is only worth 6 million because 4 has to go towards taxes whenever you pass away. Your family has to pay that. So just know there's ways to get around it, irrevocable life insurance trusts, things like that. But if that is something that you are worried about, you can hit us up. We can help you with that. And this is the one thing on social media. If you are on social media, all you're hearing is IUL, IUL. Most people didn't even know that Indexed Universal Life is the expanded version of IUL. It's an indexed product with a universal life chassis. So basically, who's it for? Those that want tax-free growth with market protection. So a Roth IRA, a Roth 401k is really the only way that you can get tax-free retirement growth. A lot of people in their 401ks don't have a Roth option. Before the Build Back Better Act, most people, 99% of people, didn't have access to a Roth option. And if they did get a match, it wasn't Roth, it was qualified, it was pre-tax. And with the Roth IRA, you have limitations. We'll just say 150,000 as a single earner. Once you start making more than that, you can't have a Roth IRA. You can't contribute to it. If it's more than, we'll say 240 as a married couple, you can't have a Roth IRA. You can't contribute to it. So the only other way to grow money tax-free within a retirement account, air quotes, is with the Index Universal Life policy and the variable and whole life. But I would argue that the Index Universal Life Insurance policy is the best for that because the benefits, you have a zero downside risk and you have a cap and you have tax-free income. What does that mean? That means if the market goes down 20%, you have what's called a floor, a 0% floor. So it's like having bumpers when you bowl. The left side is a 0, the right side, we'll just call it a 10. We've seen 12% caps, we've seen 7% caps. But for this situation, we'll say a 0 on the left, a 10 on the right. If the market goes down 20%, you have your bumpers up. You get a 0. If the market goes up 20%, you cap at 12. So you lose out on that 8%. So a lot of arguments would be like, why would I give up the option to get 8% more in my policy? Because you're not losing on the downside years. 2008 happens, people lost 40% of their portfolio. You're sitting pretty with a 0. 0 is your hero. Um, would it be a bad idea to have a tool like that that would protect you from market losses? If you have something like a fixed indexed annuity that has a floor and a cap, if you have something like Index Universal Life that has a floor and a cap, it can severely take the pressure off of your retirement portfolio as much as 98% just by having products that are indexed. With that being said, some of the myths are, they're too expensive. We talked about that before, and that is because the flexible designs. So a lot of people inbox me and say, here's my policy. I'll look it over and say, hey, it's not good. I hate to say it. Well, how come, he set it up wrong? The problem is flexible designs. You can design this for maximum life insurance as an estate planning tool. And then there's the opposite side of the spectrum where you can 7702, it's just a tax code, minimize the fees, minimize the cost of insurance, get the most amount of growth. And that's what we're talking about today. Most people don't know how to do it. If you pull up a software and you try to, if I sit in front of David and I'm like, hey, $500 a month in an IUL, here's what it is. It will automatically default to about 50-50. So right in the middle, not all life insurance, not all cash value, just right there. So if all you know to do is to type in 500, hit enter after you put the date of birth and state in, this is what you get and this is what they sell. Not knowing, most of them don't know, and it's almost, we argue about this all the time. Is it worse to not know, or is it worse to know and still do wrong by the client? So a lot of people don't know. A couple buttons later, you are max accumulation, max cash value, the least amount of death benefit as possible, the least amount of fees as possible. So with flexible designs, that is a problem, because if you can fudge this policy before you put someone into it, you can completely mess up their portfolio. And that's the reason why VULs were such a hiccup, is because no one did 7702. No one max funded a policy. They all did medium up to high death benefit, used as an estate planning tool that could grow cash value. Another myth is, annual renewable term is expensive. It's insane. Who on earth would use that? Annual renewable term is what we talked about at the end of the 30-year term, where it was $1,600 a year and it jumped up to $15,000 a year. That's because you had a fixed rate for 30 years. Well, you're 30 years older now. How old are you? You're 61. Oh, cost of insurance for a 61-year-old is way up here. But if you start off at $50 a month and then the next year you're 1 year older, it might be $51 a month. The next time it might be $56 a month. So the renewable term is going up in very small increments. What they don't understand is if this is properly funded, max funded, minimum death benefit, your cash value goes up in what's called a corridor. So as you get more cash value, your death benefit goes up as well. Your cost of insurance is actually shrinking. And by the time you retire, your cost of insurance is basically free, because let's say your cost of insurance goes to $10,000 a year, but you're getting credited $100,000 a year of interest. You're netting $90,000 and you're not even adding to it. Another thing, death benefit options. I won't get too much into this, but within an IUL, there's what's called level and then increasing. Level is mostly used for estate planning purposes. You have a lot of death benefit, your cash value starts at zero, and it can slowly go up to the level death benefit. Well, once it hits that corridor, it's different for everybody. Once it gets close enough to the death benefit, now the death benefit has to go up. So your fees are very large, the fees shrink, and then now they're maximized. Versus increasing, option B, whatever you want to call it, your fees are shrunk to the minimum and your policy will grow with the cash value. So with a flexible design, someone doesn't know how to design it. The death benefit options, they don't know what A and B means. And then the cost of insurance going up every year. The myth is that is a bomb waiting to go off. Now, the truths are you get a safe rate of return. We talked about the floor. We talked about the cap. You have the bumpers put up. So within your policy, you can expect about a 7% rate of return after fees and costs over a lifetime. The market does 9% after fees. So yeah, you're losing out on 2% over a lifetime, but you have no headaches. You're not looking and saying, what does my account look like today? It's either going to be the same because of market fluctuation, you can't lose to market fluctuation, or it's going to go up. It's fully liquid, meaning, I say fully liquid, I won't get too much into the details, but the first 10, 15 years, depending on how it's set up, it's not fully liquid, it's mostly liquid, up to about 90, 99%. But if you have $100,000 of cash value, and let's say, this deal comes up where you can go get a fix and flip for 80 grand, pull 80 grand out of your IUL. It's liquid. Go buy the property, fix it, flip it, take the money that you got from the sale, pay yourself back, and your life insurance retirement plan keeps growing, and you made some money on the side. And then a great retirement income. We talked about this in the last webinar. The 4% rule, the Trinity study, the safe withdrawal rate, is 4%. So if you have $1 million in all of your assets, most advisors will say, take 4% income per year. So on $1 million, that's $40,000. If all that is in pre-tax buckets, you're probably going to net $33,000, $32,000 a year. Within an IUL, within an FIA, fixed indexed annuity, you can get up to 8% income, and on an IUL, it's tax-free. So not only do you get double the income in a percentage, but since it's tax-free, you can get, it's astronomical. We've seen as much as 180% increase just by taking money you were putting into a 401k with no match, an IRA that has a high expense ratio, taking that money you're already putting in, reallocating it to an IUL, and getting a lesser rate of return, but more retirement income. Anything you have to add on that?
No, I think that's perfect. I'll probably cover that on the next slide too.
Okay.
If you guys, same thing, have been on social media for any length of time, you've probably seen infinite banking thrown around. You either know what it is or you have no idea. So let's just refresh your memory. If you don't know what it is or need a refresher, all that is using different types of life insurance and borrowing against your cash value, not your death benefit, borrowing against your cash value while the money in your policy still earns interest. The reason why this is important is because if we compare this to a 401k, let's just say you have 100 grand in your 401k. First of all, you're only able to typically borrow out from a stock portfolio or 401k about 50% of the total assets in there. So if you have 100k growing in there, you could only loan out about 50k. But what happens is when you loan out money from a 401k, you actually sell those positions and that money is no longer growing in the account. So you only have, in that example I gave you, 50 grand still growing in the market. And now you're paying interest on this loan. Yeah, you are paying the interest back to yourself, but that is removed. That 50k loan is removed from earning interest and future money until you pay it all back. With life insurance, it's not like that. If you have 100 grand, typically, depending on the policy, that whether it's whole life or IUL, you might have access to, let's just call it 80, 85,000 to be able to borrow out. A lot higher access simply because in a 401k, it's very variable. It's fluctuating all the time. Very high risk positions in the market. They don't allow you to loan much out because if you loan too much out, you could have a margin call and basically you end up having a higher loan value than you have in your balance, which is no bueno. In life insurance, remember we said we have guarantees and we have floors. So you can never go backwards if you're funding that account. So we have way more access to the money in there. So if we have 100 grand, let's just say 85,000 is what we might have access to. If we take that out and we want to do different investments with it, whether it's rental properties, putting your money in stocks, any type of investments, that 85,000, even while it's loaned out, is still earning interest based on the market indexes that it's participating in. So the full 100,000 is still growing your money, not the net 15 from what's loaned out of the policy. The catch with that, obviously, is when you do the loan, what do you think of that's attached to a loan? It's some type of interest. And when it comes to infinite banking, most people don't understand that different types of policies have different loan interests. So you have to make sure that you're picking the right type of policy that has the right liquidity for you when you want to borrow the money, because different policies will have different access points, whether it's 30 days after you put it in or a year later. And different policies are going to have different loan rates. Some max out at 8, some max out at 5. You have to figure out with a professional which is going to be best for you for what you're going to use it for. So that's what infinite banking is at its core. Who it's for, the typical scenarios that I've seen is typically people who are doing real estate. They have a lot of money sitting on the sidelines waiting for deals. If they don't want to have it just sitting in the bank getting 0% rate of return or very little rate of return, you could put it into life insurance policies where it earns those dividends of 4 to 5% after fees. You might be netting 4, but at least it's earning something. And that money is fully liquid if you want to go use it for other things. That's the biggest use that we see. So an example is, let's say someone has 300,000 that they put into a policy. They might want to buy some property for rentals or short term or do Section 8, things like that. They might want to borrow out 250K to purchase a property. And now that property is cash flowing, let's just say $3,000 a month. What they will do is they'll pay that $3,000 a month back into the policy to repay the loan. But while they're paying off the loan, that full 300,000 that was in there in this example still keeps getting interest and dividends, not the 300 minus the 250 that's loaned out, which would be 50 in this case. So it gives you more leverage where you don't have to have the money sitting on the sideline waiting for deals. You could have your money earning rates of return in 2 different places at once. But the thing with infinite banking that I always stress to clients is infinite banking is not about the internal rate of return, which all that means is how much money you're making in the policy. It might be 3, it might be 4, it might be 5, it might be 7 with an IUL. Infinite banking is all about the external rate of return. All that means is how much money are you able to make outside of the policy by using a structure like this. So you could go make your 10, 20, 30% rates of return in real estate. That's where the leverage is. It's not with the measly rates of return you're earning in the policy. So that's just one thing I always touch on with clients. Again, business owners, they like using this because it's a safe, liquid store of capital where what I've seen with a lot of business owners is they're trying to juggle how much do I put in retirement? How much do I put in savings? With infinite banking, you can kind of do a little bit of both of that at the same time, where what I've seen is people feel more comfortable, whether it's IUL or whole life, putting more away if they know they have access to it, where they might have been only putting away $1,000 a month in their 401k and they had some money that's going to savings to keep liquidity on hand. They might be able to do $2,000 or $3,000 a month because they know if they need it, they can go touch it in the IUL and they have full access to it without having to give up the opportunity for it to earn interest. So that's where I see this fitting for a lot of clients is they want to leverage additional capital or they just want to make sure they have very high liquidity if opportunities come up to be able to do different things with. Again, just to summarize the benefits, all it is you are able to borrow your money out of your policy without penalties. If you had your 401ks, your IRAs, things like that, you can loan out a very small amount from those 401ks. It's only 50%. So you have higher leverage there. And if you're someone who doesn't want to have the money sitting in the bank because you think banks are, crooks and they are doing crazy things with their money with fractional reserve banking, this might be a great place for you to store your capital where it's a lot safer than the banks. If you look back at, gosh, like 2008, it's almost 20 years ago now, which is crazy. But if you look back on that, we had banks go under. We had the whole real estate crisis. A lot of companies went under, but there were really no life insurance companies that went under. All of those companies were backstopped and had full liquidity during that time. So if there is some type of financial collapse, that is where you want to have a lot of your money is in insurance because it's backed way more than banks in any other type of financial product.
Real quick, the whole life versus IUL thing. Infinite banking, we really don't condone it for the most part. I think that maybe 10% of people that want it actually need it.
Right.
But if you are the person that you are looking at this and you're like, yep, this is for me, there's two things to realize. For whole life, like we said, not a lot of rate of return, but you have access to more upfront. So if you're a real estate agent or real estate investor and you are trying to cycle money quickly, whole life's going to make sense. If you can put 100 grand in the first year and have access to 80 the first year within 31 days, and you can borrow that not fixed. So like the 401k instance, you borrow out and you're actually taking out of your balance. You don't want that to actually be able to borrow from a different account and still have your 100,000 in your account. Whole life makes sense for people that are actually trying to recycle money quickly. If you're looking long term, like, hey, 5, 6 years down the road, I want to put into this policy. Now I want to start using it. Now I want to start borrowing from it. The IUL is far superior just because there's a lot of IUL carriers that have better loan rates long term and they have a better rate of return long term. So, if you have a IBC whole life policy 30 years down the road, it's not going to kick off very good retirement income. I'm just maybe 4%, maybe 5% if you're lucky, versus the IUL we talked about could get you 8% rate of return. So as long as you're borrowing from your policy and you're paying it back at a reasonable rate, and another thing we didn't talk about with infinite banking, you don't have to pay it back at all. But if you don't, you have a negative interest rate working against you. All that means is you have the terms yourself to either pay it back immediately, pay it back the next day, pay it back 6 months down the road, pay it back 5 years down the road. Your own terms are how you pay it back. So you have to be that minded person like, hey, I'm going to pay myself back. Like if I don't, the bank is going to come take my house. If you're not that type of person, you are the Dave Ramsey type, you do not need this policy. Straight and simple. And then one more thing, because again, you never know who are on these calls with the whole life, with the IUL, with the infinite banking concept, you can finance these policies. If you make 6 figures, mid 6 figures, and you're worth a couple $1,000,000, you can have a bank loan into these policies for you. So if you wanted to put $50,000 a year into an IUL, I would tell you like, hey, Fisher, $50,000 a year, it's a lot of money. How much could you make in your business if you were to go put that back into your business? 10%, 20%, 50%? Okay, so more than six, right? Then it doesn't make sense for you to put it into this policy. Why not? Let's go to the bank, let them put $500,000 into your policy. You pay the interest payment. And then in 10 years, after all you did was pay interest payments and they were putting money into the policy the whole time, we'll just exit the loan with two of your rentals. You're going to sell your business. We'll sell the business. pay the bank off. Now you have millions of dollars of cash value. So there's different ways to fund these policies. You don't always have to come out of pocket.
Mhm.
Oh, the common questions. You love these.
Oh, our favorite. And again, our big thing we really stress with any of our clients is we want to make sure people understand why and how they're doing things. I don't recommend any person ever do a financial solution or strategy if they don't understand what's going on. So we always want to make sure that people have a big foundation of understanding and education, and that typically just motivates people to work with us because they feel very taken care of and they know that we're not trying to pull something over on them. So the biggest things I've seen when it comes to these policies in terms of questions is a couple things that we have listed here. The first one is I heard that these policies have high fees. Hold on, my fan is making a noise. There we go.
High fees, the thing about high fees is if you set these up correctly, 7702, to where you have the max cash value, minimum cost of insurance, your fees over a lifetime, not over 10 years, not over 20 years, over a lifetime, can be 50 basis points. There's not many money managers that will do less than 100 basis points. So with policy fees, it's what are the fees getting you? If I told you that a 2% fee would get you a 4% rate of return and you might run out of money, you'd be like, that makes no sense. Welcome to financial advising. Now, what if I told you that a 50 basis point fee over your lifetime could get you an 8% rate of return pension like retirement account that's tax free? That fee makes sense. Not only if it was 3%, if it was higher than a money management fee, it would still make more sense. But if it's set up correctly, 50 basis points. Now, if it's set up like everybody else sets it up, 5, 6%, that is working against your account. You really got to make sure you know who you're working with. You really have to make sure that you know how your policy is set up. And again, we'll talk about it on the next slide. But if you have a policy, you're like, I really don't know if it's set up correctly. I really don't know what it's doing for me. Email it to us. We'll look at it for free. We'll tell you non-biased what this thing is supposed to do for you. You tell us what it was supposed to do for you so we don't misconstrue what the policy was set up for. And maybe we can replace it. Maybe it's a good policy. Anyways,
Yep. Sorry about that. My fan in my room just started going nuts all of a sudden. The biggest thing other than the fees is we hear the same question over and over. Well, why don't I just put my money in the market? Why don't I just buy term, invest the difference? The biggest thing that I will tell clients when it comes to this question is you do not need crazy rates of return when you don't have crazy losses in the first place. So if we look at the last 20 years of the market, some years it did 12, some years it did 20, some years it did negative 40, some years it did 27. It's all over the place. The average of the market over the last 20 years is about 7.78. In an IUL with a cap and a floor, the average is about the same, but the difference is how can we have a similar rate of return with a 12% cap? It's simply because we never lose money on the down year. So just keep in mind that you don't need a crazy rate of return to make a lot of retirement income. And simply, if you have money in life insurance like this that's protected, you can take more money out in retirement because we don't have these wild fluctuations in retirement, which is why the 4% rule is a thing of we can't take much out because we have to save for the down years, which there are none when it comes to life insurance.
real quick on the Truth About Retirement Planning webinar, you can go look at that. Join it. We talk about average versus actual rate of returns. Can you touch on that for a quick second?
Yeah. Again, I just give an example to show people this is if you have average rate of return, that's what you look at in your portfolio. And it says my average rate of return over the last 10 years is 17%. You're like, wow, that's incredible. I'm doing great. But average rate of return is just a mathematical equation and you don't realize what all goes into it. So here's an example to illustrate why that's a lie and why it's a bummer that that's what's shown on any type of financial product to show the performance. If you have $100 in a financial account, let's just say year one, you get negative 50% rate of return. The next year, 100 minus 50%. Next year, you have $50 in the account. Let's just say that the next year never will happen like this, but let's say we get 100% rate of return in the market. If we do that math, we went from 100 to 50 and we got 100% rate of return there. We're back to 100. What average rate of return tells us is if we add those two numbers together and divide it by the number of years, so that would be 100 minus 50 divided by 2 for the 2 years that the growth happened over. That is an average rate of return of 25%. But in this example, why do we still have the same $100 when we had a 25% average rate of return. The reason is because average and actual rates of return are off by about 25 to 30%. So all that means is if the market goes down, you have to make more than you lost on the upside or more than you lost on the downside to break back to even. So that's the big thing that we see with a lot of our clients is they don't understand that. They think they're making great rates of return in their portfolio, but really they haven't made any money for the last 12 years or something because you look at 2000 to 2012, the market fluctuated so rapidly during that point that if you had not put any money in your financial account during that time, you would have the same dollar value from 2000 to 2012, which is 12 years later. So we
Yeah.
always ask our clients, can you afford to not have any growth in your account for the next 10 years before you retire? Usually it's a resounding no.
It's the lost decade. It's disgusting. And I like that corny joke of like, hey, if you have one hand in a 200-degree box and you have the other hand in a 0-degree box, your body temperature is 100 degrees. It's like, no, your left hand is melted off and your right hand's got frostbite.
Yeah, it's no good either way. Another thing we hear constantly, well, I shouldn't say this is not as much recently, but it used to be a long time ago. Permanent life insurance is a scam. Why should I do this? Dave Ramsey says this. Susie Orman tells me to do this. All it is, again, when people are saying that something is a scam, they're trying to sell you the opposite of it. So just be aware that if someone says permanent life insurance is a scam, I bet you they're trying to manage your money in the market. There's nothing wrong with that, as you guys know. But simply what we have found is that people call things scams that they don't understand. Because again, like we talked about before, a lot of these policies require a professional where you can flexibly design it depending on what the client needs. So that's where things can go wrong, and you have to make sure you're working with a professional that's designing it correctly for exactly what outcome you're wanting.
Yeah. Yeah. And on the whole, somebody's trying to pitch you a product. There is a guy, probably the biggest guru in the IUL industry right now, that he says on his live calls all the time, a 401k with a match is a scam. You should put all your money into this IUL. And I'm telling you, I don't care what kind of secret sauce this guy has. I don't care how many patents he has. This is not going to beat, for most people, a qualified account with a match. If you have a 4% match and you can put 4% in, that's, let's just say $800 a month that you're putting in. If you can put that in pre-tax and 40 years down the road, take it tax free because you do the right planning, where on earth can you put money in, get a deduction, and take it tax free? Nowhere else. So again, do not listen to everybody. If they're saying that IULs are great and we're kind of saying it's not a bad idea, we're also not saying don't put into the 401k with a match.
Mhm. Dave Ramsey, Susie Orman, we talked a little bit about that, but their audience, who they cater to, is really people who are making very low money, just trying to get out of debt. And I agree with him on a lot of things, but where his information stops being helpful is what do you do now once you get out of debt? I've met so many people that they have been doing the Dave Ramsey stuff for 10, 15 years. I forget what he calls it, like his baby
Baby
steps
steps.
program. Yep.
Yeah.
And they are still focusing on getting out of debt because that's what they prioritize so much above everything else. And the thing that we go over with clients is, well, what if there was a way where you can actually pay off your debt and start retirement savings at the same time without having to pay all this crazy interest to the bank? There's different strategies you can utilize to do that that Dave Ramsey doesn't talk about simply because he doesn't have the luxury of catered financial advice because he's speaking to an audience of millions of people at a time. So he kind of goes mile wide and an inch deep just to focus on the financial disciplines that people have trouble with because I agree with him. Most people just don't have financial discipline at all. And starting there is a great place to start. But beyond that, his investment advice is just wildly off. That's why he doesn't have a license because he'd lose it.
Could you imagine? You're 50 years old, you look up, your house is paid off, your 401k is maxed out, you have nothing. You are like, I'm 50. I have 15 years till I retire, and all I have is this fat 401k tax bill. I couldn't imagine.
And you guys know, I live in Nashville. His office is 5 minutes away from my house. The sad thing is we've done events here in person a lot, and time again, we meet with people who do the Dave Ramsey approach. Guess what they say almost every single time when we meet with them when they're like 60, 65, or even in their late 50s. I thought I would have more by now. And now
Wow.
they're coming to us saying, I am behind. I'm nowhere near where I thought I would be. I'm not going to be able to retire. Almost every single time, that's what we see happen.
I mean, God, could you imagine paying off your house? You're 60, you don't have as much as you were supposed to have. Well, now you have to do the opposite of what Dave said and go get a HELOC so you can pull out of your house
Mhm.
or sell your house and go live in a shack. Like
Yep.
now, you did his program, you paid him to do the baby steps. You're having to revert, go backwards. Crazy.
Yep.
On the why would I throttle my upside with the cap? We've already talked about that a little bit already. Since you have the bumpers, you can have a better rate of return in the long run, a better retirement income. If 30% of your portfolio, there's an Ernst& Young report. I can tie it into this email follow-up for anybody who's on here or is absent. Ernst& Young basically did a report saying that if you have about 30% roughly of permanent life insurance in your portfolio, it will take a huge, significant uh, of amount of risk out of your account and give you a better rate of return and lower the ability to run out of money. I mean, simply stated, I mean, you've been through the whole Ernst& Young report. Kind of what's your thoughts on the whole throttle the upside?
Yeah. You should have a well-balanced portfolio, and by balanced and diversified, that does not mean equities and bonds. That means across different asset classes. It means so the funny thing about diversification, I have a really good friend who's a financial advisor, and this is what he says, which is how you know it's unbiased because he does insurance and investments. He says that diversification is like caring about what level of the Titanic you're on when it's sinking. It's all it's all going down. It's just a matter of what's going to go down first. So
Uh,
the reason I say that is because you should 100% have money in your 401k. You should have equities. You should have the risky money. You should have life insurance in there. You should have some annuities. You should have all three of those together. And by doing that, and at the end of the day, if you get to retirement, you should have about 30% of your total assets in some type of permanent life insurance. You can easily, without any additional risk, double your income at retirement from 4% distributions to 8 by having that setup that we just talked about, having equities, having cash value life insurance and annuities. You can double your income. In fact, I even go as far as to say that if you're not doing that, you're having your income because you don't have to live off that chunk of income. Or if you don't need the income, guess what? Your assets would grow even more if we had a structure like that going for you.
Yeah, and I say this all the time. The number one scare in the United States is I'd rather die than public speak. Number two is I'd rather die than run out of money in retirement. So not only are you having your income, you have the ability to run out of money on average in 14 years in retirement. To me, I don't want to take that risk. And if you don't, you have to pay Uncle Sam. And I don't know how patriotic you guys are. Don't take my money.
Mhm.
And with that being said, I'd like for you guys to kind of think about your biggest takeaways. If you're not taking notes, you might go back and just ask yourself, like, what did I get out of this? What did I not know before? What kind of sparked my attention? Who do I know that this one thing that we talked about, didn't make sense? Or, hey, an advisor that they're completely against permanent insurance and now you have this information? Just think about it, write it down because if you don't take notes, you are understanding things, but you are not able to retain it. Unfortunately, I learned that lesson the hard way. It took me until last year to actually take notes and write things down. I look over at Fisher and he's got 5 pages of notes, and I put seminar. And I'm like, man, what am I doing here? So, if you want to schedule a quick strategy call with us, we have the QR code in the bottom left. You can scan that. That's going to go to my booking link, free consultation. We can look at a custom policy illustration. We can review a policy. So we talked about it before. If you have any kind of permanent insurance at all, and really term insurance too. So if you have a term insurance policy that's 5 years or less, there's most likely, if you're using certain carriers, you're being way, way, way overcharged. And I won't really just name drop, but one of them, both of them rhyme with America. They're really, really expensive cost of insurance. We can look at those and see if replacement makes sense. But I appreciate you guys jumping on. Once again, this is one of a series of 7 webinars that we put together. And again, we have the Financial Literacy 101 as of the recording right now, and then the truths about retirement planning. So besides that, appreciate you guys showing up, and we'll see you on the next one.